Welcome back. Now, the Reserve Bank has decided to keep rates unchanged as expected. This is the third pause with the MPC leaving the repo rate at 8.25%. Surprisingly, all 5 members of the MPC have agreed to stand pat on rates. And still with me is Koketso Mano, Senior Economist at FNB. And joining me now with Koketso is James Turp from Sanlam Investments. So thank you so much for joining us this afternoon. James, let's start with you. Your initial reactions. What have you made of the decision today?
Thank you very much. Yeah, looking at it, there were no real surprises, I'm afraid to say. We came into it earlier this week expecting a unanimous hold, and it turns out that we got that. So I think, the only thing was perhaps the CPI number that came out during the week surprised us all to the upside, didn't it? And I thought perhaps we might see one call for a hike just to send that hawkish signal into the end of the year, as we know is traditionally how the MPC likes to behave. But I think we got that in the messaging either way, so unanimous hold it was. So no real surprises, I must say. I really like listening to the Q&A just there to hear some other things that the governor had to say. But looking through the details, we probably could have wrote this script between Koketso and I before the MPC. Slight markdown of the inflation forecast, slight improvement on the growth outlook, risks to growth balanced, risks to inflation to the upside, and seriously to the upside was the word used, and they remain data dependent. So that pretty much sums it up from our point of view, and no surprises there.
Koki, let's talk about that stance. We're getting a more hawkish stance as usual from the SARB, right?
Correct. So we're not surprised about that. We also saw, the Fed remaining relatively hawkish. So there's still a bit of inflationary pressure, and we spoke about that earlier. Going into 2024, a lot of countries are still battling with inflation above target. So we expect the MPC to remain hawkish, trying to manage inflation expectations, trying to make sure that they don't de-anchor, but also at the same time also managing financial conditions as well. So that there's no material loosening there that can undo whatever the MPC has intended to do with restrictive interest rates so far. So no surprises in terms of the hawkishness, and especially because inflation risks are still to the upside. We saw them hiking food inflation, for example, but not as much as we anticipated, especially following yesterday's number. What we think is that the MPC probably didn't have this in the number from yesterday in their forecast. So maybe in January we see another lift to food inflation if the numbers don't pan out in a positive manner. But hawkishness is definitely warranted here.
Yes. Now, James, I want us to look at some of the market reaction, or how the market didn't necessarily react to this move. The last time I checked, the rand was at 1877. Right now, it's at 1878. The JSE is still in the green. So I guess traders just kind of shrugging this and being like, yeah, we expected it.
That's right. I almost hit the reset button there because it looks like we're kind of where we are as we opened. So, bonds going into the MPC had weakened somewhat, and they've moved right the way back to where they opened. And the rand the same. Yeah, you have to tap the screen. It's back at 1877. It's had a bad week, admittedly, up as high as 1888. I should point out it's a dollar holiday.
Yes.
So we probably are a little relieved from international developments. Certainly US Treasury is not moving at the moment, so the currency probably going to be a bit stable. But the rand is normally a good place to look to gauge what surprised the market. So if the rand strengthens, it's deemed more hawkish. The rand weakens, the opposite. Obviously, it's a bit more dovish than was expected. So going on this and considering that the US market's out, I think it's, as you say, as expected. I'm afraid I can't make up anything more interesting than that at the moment.
Sticking with market reaction, I want us to maybe talk about what we see when perhaps the Fed makes these policy decisions or releases minutes. And there's been somewhat of a trend where you see markets trading higher when the Fed hits pause on rate, but still has a very hawkish tone. Do you think that markets are getting a bit too excited or are anticipating rate hikes sooner than expected?
Yeah, I would say, it's a difficult one. If we look at our market locally, we're almost mirroring what's expected from the US market, which is about the middle of the year, a 25 basis point cut. I don't think that's unrealistic. Of course, the expectations are that growth is going to slow quite quickly over in the US. And if it defeats that, obviously, well, that's a different story. Then it's a case of higher for longer, which you could probably build an argument for. But it seems at the moment like the next move will be lower for rates. And the timing of that, I think we're kind of conservative with the middle of the year. Things could develop quite quickly earlier next year. So no, I wouldn't say that. I think if anything, if you're a fixed income investor, you're probably right to be extending duration a little bit in your income funds at this point, taking advantage of rates where they are at the moment. Remembering, though, that we have moved down quite a bit over the last couple of weeks as well. So as markets are, there could be some bumps along the way as well.
Koki, just coming back to you, with everything that we've heard from SARB Governor Lesetja Kganyago, surely this doesn't move the needle for you in terms of your expectations as FNB?
Yes, I mean, the decision was broadly as expected, and the outlook is broadly mirroring what we have and what consensus has as well. So no surprises there on our end in terms of our 2024 expectations. We still see interest rates coming down from nominal interest rates, that is, coming down from the middle of that year. As I said earlier, post-elections, post any adverse risk sentiment around that time. But it's so important to note that, interest rates are probably going to remain either restrictive or neutral, which is something that we mentioned earlier as well, simply because when you have, your inflation coming down, which we expect to see more pronounced in 2024, that means that your real interest rate is also starting to rise. So from a real interest rate perspective, we still see interest rates remaining restrictive. And so that high for long theme is also part of our, it's also a feature of our forecast as well. We're generally seeing interest rates remaining high. And we think that it's a problem not only for SA and inflation per se, but it's also a neutral issue. And the SARB governor did spend a bit of time speaking to this. When you have a demand for savings across the globe, your interest rates in advanced economies are also competitive. That means that you need to also, make sure that your interest rates internally are also competitive enough to drive some of that capital to SA. So we think in general that should keep interest rates relatively high for long.
James, where is your head at in terms of interest rates? Is there room for another rate hike, or is this the end of the hiking cycle?
So I'd cautiously say it's the end of the hiking cycle, unless, and we know the rand is the least predictable creature in the financial markets. So, barring any surprises, which we're used to many, I think we're at the top of the rate cycle. I want to build a dovish case from this MPC. I can look at his underlining that rates are restrictive, he said. So, that is certainly something that will be on his mind. Of course, moving GDP up slightly is still at really low levels, though. So they'll be aware of that, of course. And I think one thing that we haven't spoken about that does spring to mind, though, is we've got elections next year. So they might, in the back of their mind, also be thinking that should it not be plain sailing at the elections, should there be some surprises there that could destabilize the currency market, then they want to keep their powder dry. They don't want to be lowering interest rates into the election, I wouldn't have thought. So that makes me quite comfortable to say at least to the middle of the year rates are going nowhere. The next move should be down, but I think they want to see more data supporting that sort of a move and get through those elections safely.
Now, sticking with that political kind of theme, Koki, we've also had the recent midterm budget, was kind of welcomed by markets, but surely those fiscal risks and the declining revenues could somewhat impact the SARB's or the rates trajectory?
Yeah, I mean, the SARB is currently working with a revised version of the QPM that has, a fiscal block in there, and you can see how if Treasury doesn't meet its targets for debt, for gross debt, that is, that generally lifts neutral through the risk premium. So unfortunately, debt dynamics in South Africa's fiscal position is not very supportive, especially when you think about the longer term trend. We are not peaking at the level that we thought we would peak at, so that continues to add upward pressure to the risk that can be associated with South African assets. And it was spoken to in the Q&A as well when you think about yield curves and how our yield curve is relatively steep when you compare to other emerging markets. So unfortunately, that is something that will probably remain on the MPC's mind when it comes to funding risks, but also, loose fiscal policy, especially heading into an election year. Loose fiscal policy does add inflationary pressure, but in this context, we really think that it's more of a funding risk rather than an inflation risk.
And the SARB continues to fight sticky inflation. And this year we heard Governor Kganyago saying that he wants to reduce the inflation target range from 3.26 to 3%. What's your take on that, James?
It comes and goes, doesn't it? Of course, it's easy to do it when inflation is lower. But of course, with this last pop up to 5.9, there was no mention of that in the Q&A or at least certainly in the speech. But it certainly is a passion of the governors to get inflation down. He says it in every interview, how the lower income people in South Africa are the worst hit by inflation, and getting inflation down means longer term lower interest rates. It's a mantra he repeats regularly, and I think he'd be quite happy to leave when he does eventually the MPC and South Africa in a better place with a lower inflation DNA, if you like. So I've no doubt that that's the intention. Of course, the challenges are what is going on with administered prices and things that are difficult for the MPC to solve. So yes, it is on the to-do list, but I think the first thing is just to get inflation down comfortably in line with their forecast to the mid at 4.5. And then I think if they're comfortable that it's there, if global inflation's in check, then you can look at moving the inflation target down, or even creating a point target, which is something that they talk about as well, as opposed to a band that they target. So yes, I would say, but no, when it comes to how imminent it is, I think there are bigger fish to fry, and that's getting inflation comfortably to the mid of the target for now.
Koki, just same question to you. What is your take on that?
Yeah, I'm totally in agreement. The timing is just off at the moment. And especially because we mentioned this earlier, if you remember that global inflation is still expected to be sticky going into next year. Geopolitical tensions, the changing of supply chains may also affect that trend in inflation. So it wouldn't particularly be a good time, given all of these inflation risks at the moment, to try and move to that 3% number, for example. But the thinking around the MPC, or the thinking of the MPC around this lower target is just to boost our competitiveness. So it's something that they think is probably important. It's also something that will also help us to maintain an inflation target that is easier to work around, whether you have a buffer to the upside or it's just more there's more confidence to that inflation target. So that's just something that they're thinking about, and I think over time they probably will move towards that. But right now is probably not the right time.
Koki, James, thanks so much for your time and your insights. Unfortunately, we have to leave it there. That was James Turp, Portfolio Manager for Fixed Income at Sanlam Investments and Senior Economist at FNB, Koketso Mano.